Okay, let's get started. So somebody asks about the budget briefing. Yes. So part of this, there are really two parts to this annual budget briefing that we do. One is the presentation and the other is a publication. And our publication is kind of hefty this year. We've done a fairly detailed retrospective study of what went on with the state budget and financial policies during sort of post-fiscal crisis or post-financial crisis period up to COVID, and that's full of interesting information. So we'll send that out pretty shortly after this presentation ends. It'll also be available for download on our website. So with that said, let's kick off this presentation. I want to introduce Andrew, who's FPI Senior Policy Analyst. He's going to walk us through the economic outlook for the next year to few years, talk about the governor's financial plan, and then he'll pass it back to me, and I will talk about certain policy highlights from the executive budget, as well as our own FPI views really around tax policy. That's something that we focused on. That's also my specific background as someone who's formerly a tax lawyer. And we're going to talk about where we think there are real opportunities to raise meaningful revenue that could fund a kind of expansive social investment vision. So Andrew, why don't you take it away?
All right, thank you, Nathan. Welcome everybody. So we're going to start with the economic outlook. We're going to see how the economic outlook has really substantial bearing on fiscal policy in New York State, both this year and it has substantial bearing about how we think about budgets in the going forward and looking at some substantial revenue gaps that have materialized in the governor's executive budget proposal. So we're going to start with an overview of the U.S. economy, and then we'll move through a quick snapshot of where the New York State economy is before tackling the financial plan. So, you may have heard that the economic outlook for the U.S. for the next year is unusually uncertain. I think professional economic forecasters tend to be mixed on whether or not they'll say that they think there's going to be a recession, but they'll tend to agree that the uncertainty is unusually high. So their confidence in whether or not there may or may not be a recession is not going to be very high. And everyone also agrees that growth is probably going to slow in 2023 relative to the last couple of years of relatively faster growth during the recovery from the COVID recession. So in this table, I have a bunch of acronyms from professional economic forecasters. If you want to know what the acronyms mean, you're welcome to look in the budget book that Nathan has mentioned that we'll be sending out right after this. But most forecasters predict the US economy after adjusting for inflation is going to grow anywhere from 0.5% to 1%. The governor's executive budget takes sort of the lower bound of that. They are expecting 0.5% of real GDP growth. And then we get, you don't want to overinterpret any one week's economic signals because we get good news some weeks and bad news some weeks and ambiguous news other weeks. But I do include at the bottom of this table one possible optimistic signal, which is that after pretty consistent downward revisions to expected US growth, the IMF in its most recent economic outlook actually revised their projection for US economic growth upward by 0.4 of a percentage point to 1.4% real GDP growth for 2023. So as I mentioned, this is going to have substantial bearing on what the New York State Division of Budget thinks revenue for the state is going to look like in the next year. But before we get there, we'll do a quick overview of New York State's economy over the last couple of years. So New York State was hit unusually hard. It was hit harder than the rest of the country by the COVID pandemic, as we all know. And after falling pretty quickly, the state's employment had relatively brisk recovery of its employment through the second half of 2020 through 2021. And then it's actually slowed fairly significantly in the second half of 2022. So we see employment employment growth for the state start to slow in the second half, and it's remaining about 5 percentage points below pre-COVID levels. And then what's noteworthy is that it's converged with the labor force. So the labor force is a broader metric which includes all the New York residents who have jobs, as well as unemployed New Yorkers. So the convergence of employment and labor force really points to the normalization of the unemployment rate, while the workforce overall for the state sort of continues to struggle and has sort of seen a slower rebound more recently. So unemployment for New York spiked higher than the rest of the country in the early phase of the pandemic. It was about 4 percentage points higher than the US unemployment rate. And then it saw pretty brisk recovery through the last 2 years. That has slowed recently, but it's continued to converge with the US unemployment rate. So the most recent metrics we have the New York unemployment rate about 0.6 of a percentage point above the US unemployment rate. Now, what's worth noting here are a couple of things. One is that this unemployment is mostly concentrated in New York City. If you look at just the rest of the state, the unemployment rate is about par with the rest of the country. And then it's also worth noting that, as we have concerns of a recession, the fact that New York's employment situation has continued to sort of is a little bit weaker than it was before COVID and than the rest of the country. It leaves New York's economy a little bit more vulnerable to a possible recession than the US as a whole. So labor force is one metric of looking at the state's economy. And another metric is looking at total employment, referring to the number of jobs in the state rather than the employment status of New York State residents. So by this metric, New York is doing a little bit better than the labor force statistics. We're about 2.5 percentage points off pre-COVID levels by the number of jobs based in the state. And this divergence is really attributable to the faster recovery of New York City. Of course, the New York metro area has a higher percentage of its jobs that are held by residents of other states, New Jersey and Connecticut. And while New York City was hit harder earlier in COVID, it's since seen considerably faster employment growth than the rest of the state. So employment in New York is about 2% off pre-COVID levels, where employment for the rest of the state is still a little bit more than 3% off the rest of the state. So what industries have gained jobs and lost jobs? Interestingly, and of pretty critical importance for the state's fiscal outlook, we actually have two sectors that are above pre-COVID levels, and these are professional services and information services, which includes a lot of tech jobs and media jobs. So these two sectors have higher average wages, which is pretty critical for the state's revenue and fiscal outlook. And then what's also worth noting here is that the leisure and hospitality industry, which tends to be concentrated in New York City and is more tourism intensive, was hit the hardest by COVID. Over the last year, it's grown the fastest of any sector, but it still remains the furthest from pre-COVID levels. So there's still a lot of rebound that we need to see, especially in this sort of tourism intensive sector that's focused downstate. And then one other set of New York economic indicators are GDP and personal income growth. What's interesting is that while New York's income was sort of knocked off the pace of the rest of the country during 2020, over the course of the second half of 2021 and 2022, it's actually converged such that both New York GDP and US GDP are about 4 percentage points higher than pre-COVID levels after adjusting for inflation. So the fact that we have this divergence between employment, which remains depressed in New York, where the rest of the country's employment has already surpassed pre-COVID levels, and yet GDP is tracking US, really points to the recovery of some of these higher wage and higher value added sectors, especially concentrated in downstate New York, that contribute relatively more income to the state's GDP. And New York's personal income remains a little bit below the US trajectory, but by less than the employment gap. It's about 2% below the US personal income trajectory. So what does this all mean for New York State's budget? Well, I mean, it results in a sort of odd discrepancy where in the current year, in the fiscal year that's closing, 2023, this sort of brisk pace of employment improvement and growth in some of these higher value added sectors of the economy have actually resulted in substantial surplus. So we're going to close fiscal year 2023 with an $8.7 billion surplus. The budget is balanced in the governor's executive budget proposal, as is required by the state's constitution. And then the state now sees pretty substantial budget gaps for each of the 3 out years that they have in their financial plan, which is a sharp deterioration from last year. In last year's enacted budget, each out year was actually balanced, which itself is somewhat anomalous for New York State. But these out year gaps have now opened, and as we'll learn, these are really entirely the result of DOB's more pessimistic economic outlook and downward revisions to what they expect the state's economy to do and its revenue, rather than any structural spending imbalances. So here I have a couple of indicators for New York State's economy that are contained in last year's enacted budget and in the current executive budget proposal, and the amount of revenue that the state expects to take in for each of the 3 years for which projections exist in both documents. So to some extent, what look like relatively modest downward revisions in economic growth result in pretty major downward revisions in expected revenue. So personal income in fiscal year 2025, for instance, has been downgraded by 1/10 of a percentage point, and total employment growth has been revised down by 4/10 of a percentage point. But this has resulted in an average revenue loss of more than $6 billion each year in the governor's executive budget proposal relative to last year's enacted budget projections. And let's take a look at how those projections have gone recently. So pre-COVID, the state's revenue projections tended to match pretty closely with the actual revenue that the state got. So they would, you make revenue projections at the beginning of the year in your enacted budget, and those track pretty closely with the actual revenue that came in. Obviously, in the COVID era, economic uncertainty has been much higher, and it's much harder to make solid predictions about the economy and therefore about how much revenue you're going to take in. It's the Division of Budget's job to budget somewhat conservatively because you want to minimize your downside risk, right? It's better to end the year with a surplus than to have an unexpected revenue shortfall. And that's exactly what's happened in each fiscal year since COVID. The Division of Budget has underestimated actual revenue, and the underestimates have actually been growing, such that this year's $12.4 billion gap between what was estimated in last year's executive budget and the revenue that actually came in fiscal year 2023 is the largest that we have on record. So we have this interesting divergence between surpluses each year during COVID as the economy has done better than expected, and then increasingly pessimistic out-year projections, not just for the current year amid concerns of recession, but for each of the out years for which projections exist, such that by 2027, the revenue projected in the current budget is $6 billion less than the revenue that was projected in last year's budget. Okay, so what are we doing with the surplus, the surplus that we have closing out fiscal year 2023? To a large extent, the answer is they're going into the state's rainy day reserve funds. So New York State has long lagged the rest of the country in building reserves funds. It has historically had some of the smallest reserve funds relative to the size of its budget of any state, and this leaves it pretty exposed to economic downturns. So both during the 2008 recession and the COVID recession, the state generally has to look at pretty significant cuts to revenue to spending, unless they receive aid from the federal government or raise their own revenue. And in both crises, it's been some combination of all three things that have happened. So since COVID, it seems that the state's lawmakers have taken reserves more seriously, and they've been building up towards this goal of having $20 billion in the state's economic reserves. And so in fiscal year 2023, the state planned a pretty brisk schedule of making deposits into its reserve funds every year through fiscal year 2025. With the revenue surplus in the current fiscal year, they've actually prepaid all of those planned deposits, which totaled $8.3 billion across fiscal year 24 and 25. Of that, 2.4 billion was planned for 2024. So that's $2.4 billion in planned reserve deposits that are being made out of the surplus that frees up that money for to support a higher base of spending in both fiscal years 24 and 25. Now, I mean, this seems like a prudent use of reserves, or a prudent way to build up reserves is to fund them out of non-recurring and unexpectedly high revenue. Something that is worth keeping an eye on is if there are sort of these recurring above expected revenue results. How is the state going to continue to build reserves and continue to increase its reserve funding goals, or come up with some other use? I mean, this is a major thing that FPI is going to be keeping its eye on. All right, so that all sets the stage for what's in the actual budget this year. So the state's expecting $125.8 billion in state operating funds revenue, but half of that comes from the personal income tax, which is typical. And then they're going to spend $125.2 billion, of which most is accounted for by its healthcare, by Medicaid, and by school aid. And again, this is pretty typical of New York State budgets. These are the two major spending items, are school aid and Medicaid. And those two programs account for most of the spending growth for the state operating funds budget. So we're expecting the state operating funds budget to, or the governor's executive budget proposal expects the state operating funds budget to grow by 2% from last year. After you account for the higher than typical inflation, this would actually be a real decrease of 1.4%. And most of this growth is included in, or is accounted for by Medicaid and by foundation aid. To support a higher base of spending, they also take two pretty significant revenue actions. One is to extend the corporate tax surcharge that was enacted in fiscal year 2022, which raised the corporate franchise tax rate for 3 years, and the governor is proposing extending that for an additional 3 years. And then they're also going to take a significant revenue action that's not actually part of the budget, which relates to the payroll tax that funds in part the MTA. This is not part of the state operating funds budget, so we're going to talk about this in more detail later, but it is a pretty significant proposed revenue action. So the really, I would say the most notable expenditure proposed in the fiscal year 2024 budget is fully funding foundation aid for the first time in after sort of decades of litigation about how school aid is funded. This goes back, I think 15 years or maybe 2 decades now of court battles about fund that require the state to fund what's called a sound basic education, and which is determined by a formula that's never actually been fully funded. This year is the first time that they're going to fully fund it, and this is going to require a $3.1 billion increase in school aid, which represents a 10% increase. And then the other major increase is on Medicaid. The state is expecting to spend 2.9, or is to increase Medicaid spending by $2.9 billion, which represents about a 9% increase. Now, on the Medicaid side, this is partially offset by an increase in federal aid through the end of the year. and by a cost shift to localities. So in the past, the state has split its enhanced federal aid with local governments by the same proportion of sort of the way the costs are split between the states and locals. And the fiscal year 2024 budget proposes ending this, where they're going to keep all of the aid. And in fiscal year 2024, this is going to cost local governments, I think, about $620 million. And as we document in the fiscal history section of the budget book, this sort of follows a pretty long tradition of the state filling its budget gaps and supporting state expenditures by shifting costs onto localities, and sort of continuing to squeeze local governments. So this is a new policy, but it does sort of follow in this vein. And then there's a couple other pretty significant spending items that are worth noting. The executive budget proposes spending $944 million to support asylum seekers in New York City. It proposes a suite of spending items related to the MTA. We're going to talk about some of this in the legislative section because some of them are legislative and not part of the actual state operating funds budget. But what is part of the state operating funds budget is a $300 million one-off payment to the MTA this year, and then an increase in the recurring state operating support for the MTA of $260 million. There's also a suite of spending initiatives related to SUNY that total almost $500 million. These are kind of spread across a couple of programs, but they would represent a major increase in state support to SUNY. The state is also proposing allowing SUNYs to hike their tuition. So we sort of wanted to contextualize the budget in the longer fiscal history of New York State. So, we go into this in pretty considerable detail in the budget briefing book. So if this is interesting to people, I would urge you to check that out. But we wanted to call attention to some of the major trends. So we started our fiscal history right before the 2008 recession and used that as a baseline, and then looked at the response to the 2008 recession and brought that forward to the response to the COVID recession. So after 2008, the state initially cut its budget in response to fiscal strain, and then embarked on about a decade of sort of a policy choice of restraining spending. So there were spending caps, and then as the state's economy grew, and therefore the size of the state and the role of the state in public life shrank relative to the state's economy, the state sort of returned a lot the revenue that was generated by all this economic growth in the form of tax cuts, and tax cuts that primarily benefited corporations and high-income individuals through both corporate tax cuts, personal income tax cuts, and a rising use of corporate tax breaks. So we kind of track this decade of restrained spending and an eroding state through the decade. And then in the initial phase of the COVID crisis, it looked as if the state was sort of embarking on a different trajectory, where higher revenue that was the result of both stimulus and by revenue action that was taken by the state actually increased the size of the budget and increased spending to support New Yorkers who were hit hardest by the effects of the pandemic. Now, what we've seen with last year's budget and with the governor's current proposed budget is actually appears to be a return to pre-COVID fiscal policy, where the state budget is being eroded by inflation. It has relatively lower growth, and therefore is continuing to decline in relation to the size of its economy. So we documented where these cuts occurred. So in the pre-COVID fiscal policy, there were pretty substantial reductions in spending on social welfare, on local government assistance, and parks and environment after adjusting for inflation. The initial response to the COVID actually brought channeled a lot of the relief funding through social welfare. all of which only brought social welfare back up to the spending, to its spending level before the 2008 recession, after adjusting for inflation. And then other areas like local government assistance and parks and environment sort of stayed at those pretty depressed levels. So they didn't benefit from higher COVID era spending. Now, what's worth noting to conclude this section is that a lot of on both the revenue side and the spending side, with these sort of social welfare programs and health spending, a lot of the policy changes during the COVID era were temporary. So as we see some of these spending and revenue actions start to expire, and as we sort of return to this this sort of pre-status quo of spending growth that's outpaced by economic growth, it looks like we're returning to the pre-COVID fiscal policy of sort of spending and fiscal restraint. So with that, I'm going to turn it back to Nathan to do an overview of the policy proposals.
All right, so let's go into what some of the actual policy proposals are in this executive budget, and we'll give you some comments, and then we'll move on to some of our own ideas. So to start out with, we want to talk about indexing the minimum wage. This one's interesting in fiscal terms because it has a small fiscal impact, but most government workers aren't minimum wage workers. So it's really a legislative proposal rather than significant spending proposal. The first thing to keep in mind is that the whole point, it can maybe get lost a little bit if you're just looking at the numbers. The point of indexing the minimum wage to inflation, which is something that a lot of states have done and a lot of people are talking about right now, is to maintain the real value of the minimum wage. So even though in just dollar numbers, it looks like a wage increase, it really keeps the wage flat in terms of its real purchasing power. So with that in mind, the governor has spoken about this, and her executive budget proposes indexing the minimum wage, but it's a very sort of restrained and caveated structure. So the biggest thing it misses is that it would take effect prospectively, but it wouldn't pick up the recent period of high inflation that we've had, which in historical terms was really pretty high compared, basically going back until the late 70s, got up to 7.5% over 2022. Inflation is coming down, but it's still relatively high compared to the last few decades of inflation. So what this chart does, and there's sort of a lot of boxes here, but the top row shows you inflation, and then it shows sort of reasonable projections of inflation for the next 2 years. Then it shows the minimum wage if it were indexed under the governor's proposal. And then it shows you what the real power of the minimum wage would be in 2018 dollar amounts. So, I mean, that's very recent, but again, it's just because of the recently high inflation that you see these effects. So the most interesting line here is on the bottom, where you can see that the real purchasing power of that $15 minimum wage that a lot of people fought pretty hard to get in New York declines to about $12.50, even once you start indexing, because there's basically been a lot of ground lost in these past few years. So that's maybe the biggest immediate problem with the executive budget proposal, but there are other problems, like it limits increases to 3% per year. So if we were to get into a fairly high inflation period, you could have substantial losses in purchasing power. There are also other off-ramps and caveats where if unemployment rises by a certain amount, or if you have job losses, then you don't index the minimum wage upwards for that year. So while it's good in principle that the administration is on board with this idea, it doesn't really have the structure that you would want in this kind of proposal. And here we show what those look like graphically. So the bottom line shows the governor's proposal, and these are just real dollar amounts. It'd be flat, and then no one really knows what's going to happen in the economy over the next few years. But if you assume this, like we had above, certain moderate ongoing levels of inflation, or sort of low moderate, then you'd have a rise in the minimum, in that indexed minimum wage to just over $16. But if you were to really try to recover all the lost ground from these last few years, and you indexed it starting in 2018 or 2021, those you see a much steeper rise in the value of the minimum wage, up to about $19 or $19.50. So that's really where you would need to get in order for the minimum wage to maintain its purchasing power. And just keep in mind that that means there's a very significant economic benefit there, which is that you've really increased the collective income of low-wage workers. Low-wage workers tend to spend almost all or all of their income. So it has a pretty high stimulus effect on the economy. People are basically just buying more. That means people are doing more business. You contrast that with sort of wealth hoarding tendencies, where a lot of the accumulated wealth at the top end of the income spectrum is not really being deployed productively, and it's not being spent. So we want to talk about economic development for a few reasons. First of all, this has traditionally been something that FPI focuses on a lot because economic development spending in the budget is in the tax code, and we pay a lot of attention to tax policy, but it also represents a kind of continuity of policy philosophy between the previous administration and this administration. The idea, which is probably a bad idea, that's not correct, is that you just keep on giving out business subsidies, and that's a good way to incentivize businesses to do more business, or incentivize people to open new businesses, incentivize businesses to move from other states into our state. A lot of money goes into these subsidies every year. We'll get into a little bit of the details. If people have questions, please put them in the chat, and then we'll reserve some time at the end to address them. This may be something that people are curious about, but it's just worth noting both the magnitude of some of these subsidies as well as the range. So the biggest one, the biggest deals tend to be these one-off deals that are individually negotiated by the governor and some business. So that would be like the Micron deal, which is a semiconductor manufacturer. So they say they're going to invest $100 billion, and New York is going to provide them with over $6 billion in tax benefits. Tax policy point, you talk about that as narrowing the tax base. So you might hear that and think that it's like a bad payment to some big business. You might hear that and think that maybe it's a good bet, and maybe that will incentivize them to open up a bigger factory here. But the real upshot is that it just forces everyone else to pay higher taxes. Right? If everyone pays the sort of same property tax rate or same income tax rate, then you have sustained revenues and everyone can pay a lower tax rate. When you start to carve out all these holes in the tax base and give out all these exemptions, you lose revenue, and then you force everybody else to pay higher taxes. So there really should be a lot of people shouldn't be unhappy when they hear about all this money going out the door. But in addition to those big one-off deals with big companies, there are also just a whole lot of different little incentives that are currently scattered throughout the state's tax law and are also in this executive budget. One of the most interesting ones, basically, because it strikes me as very silly, is what they want to call this the EPIC program, but it's just a rebrand of a pre-existing program called Startup New York, which basically said that if you start a business on or near a SUNY campus, it's tax-free, and it's like really tax-free. You don't pay any business tax, but the people who work for the business don't pay any income tax. And that is a crazy policy suggestion. It turns out that it wasn't a very popular program and had very low uptake rates, but it still cost the state around $100 million just to market the program, and in some tax losses. So setting aside the kind of revenue concerns, there's also pretty clear academic consensus that these little giveaways and tricks are a really bad strategy for incentivizing business investment and actually growing jobs. Now, the biggest proposal within the executive budget is a significant expansion of the film tax credit. It's currently around $450 million, and the proposal is to raise it to $700 million. So that's just a lot of money going right into basically the government sharing the costs of these private businesses in the film sector. Moving on to the MTA. I mean, the MTA is a very timely issue because you can't really overstate the importance of the MTA to the city economy, and the city economy really drives the state economy. So the MTA is currently looking at about a $3 billion operating gap. So that means that the actual revenues, the amount of money that they have to spend largely on payroll, paying people who operate the trains, people who work on the tracks, as well as other yearly maintenance costs, that is $3 billion over what they actually receive in funds that they can use to pay those expenses. There's a difference between the kinds of funds that you can use to pay your ordinary operating expenses like payroll and the kinds of funds that you can use to invest in longer term durable assets like rails and buildings or subway stations. Capital financing is kind of different, but the importance of making sure that you close the operating gap is that if you don't, then you have to suspend service or lay off workers, or what they often do is just defer maintenance, and that's how we end up with derailing subway trains. So the governor's one, I'd say, sort of sustained proposal for addressing this gap is the increase in the payroll mobility tax. So payroll tax is a tax that a business pays on its employees' wages. And it's generally thought that that probably eventually gets passed on to the employees. So it's a bit of a regressive tax, but it's probably a good tax base to fund a service like the MTA. But given that the payroll tax is already kind of regressive, it would be good to look for more progressive sources of revenue to make up the rest of this operating gap. And most importantly, you want recurring sources of revenue. What we have here is basically a cobbled together picture of other one-off spending sources. So part of it is about $300 billion in state operating aid. That's a one-time payment. Part of it isn't a funding plan. Part of it is saying that the city government will have to pay another $500 million into funding the MTA. And then they've done this thing where there are a number of casinos that have been basically permitted to open up, or prospectively permitted to open up in the city. And to open one of those casinos, you have to pay a very high one-time licensing fee. So they expect about $1.5 billion just from licensing 3 casinos. Now that's not like a tax, that's just a fee you pay to open up the shop. Statutorily, those were currently required to go to pay for education, but the governor's plan is to divert them to paying for the MTA. They also want to divert some casino revenues that are recurring and annual into paying for the MTA. So evidently kind of questionable whether you want to be diverting dedicated educational funding to closing this gap when there really are alternative funding sources, like I said, particularly around looking at business profits taxes generally, and also some of the dedicated business taxes that are currently used to sustain state operating aid to the MTA. And it doesn't fully close the gap anyway. So we think this proposal really comes up short. Another sort of big programmatic area is thinking about childcare. Childcare is basically important because it's very expensive, and it's this one-time cost that spikes for pretty much every family early on in the life of a child. The childcare costs can be around $20,000 to $21,000 annually, and even if you're an upper middle income family, to have your annual cost of living rise $20,000 is a very significant hit. So there's been a lot of interest in the state, but also nationally, in thinking about how to move towards a more universal childcare system that would be publicly financed and readily available, and not just rely on this more administratively complex system of subsidies. But the governor's proposal doesn't really move in that direction. The governor has marginally increased the eligibility level to get those state subsidies from what it was previously. For a family of 4, the increase this year is from about $83,000 to $93,000. We think that for the children who really use childcare, which is basically children under the age of 6, that would increase eligibility by about 20,000 children. And it approaches the federal limit on subsidy reimbursements, which is 85% of the state median income. What we show here is that these expansions of the eligibility level have been shrinking over time. So, previously we had some very significant expansions in fiscal year 23. It was expanded by about 50,000 eligible kids. Now the expansion is about 20,000 eligible kids. And the red lines here show all remaining households with young children. So that's kind of everybody who's left out of this picture. Last thing we want to go over is, which again, interesting in terms of not exactly being a fiscal item, but the governor has this big housing initiative. And in a way, there's a lot to like because we've looked at the costs of housing and the costs of rent, and it's a very urgent problem, as anybody knows who reads the news. But the policy strategy of this housing plan is, it basically consists of changes to local law requiring that localities permit more housing production. So high level, that's a good thing. That there does need to be more housing production in a lot of within the city and a lot of the surrounding suburbs. But it also uses a lot of tax incentives to motivate those expansions. There's fairly little direct funding within the plan for housing. It's a $250 million infrastructure fund, but in the context of a plan to build homes for hundreds of thousands of people, that's a pretty small amount of money. It also cuts off $1 billion in rental assistance, meaning that tenants who are not looking to buy homes anyway, and who have really been struggling throughout the pandemic, and then with the skyrocketing rental costs, they're going to be out of luck. Okay. We have 15 minutes left, and I want to have enough time to take questions, but we also want to be able to tell you what we think about tax policy, because that's where we're not just telling you what the governor does, but we have some of our own ideas. So I'm going to move through this a little bit quickly, and there's a bit of intro material here that I always like to explain just vis-a-vis how to think about tax policy. So the first thing to note is that even though New York, by comparison to other states, is relatively a high tax state, and people talk about it being a high tax state, if you really want a picture of how the whole tax system fits together, you have to sort of see how all the taxes add up, and then see how that burdens people. So this notion of burden is pretty essential to any tax policy discussion, because what really matters is not the amount of money you pay, and not even really the tax rate you pay, but how burdened is a taxpayer or a family by their taxes. And there's a economic concept called the declining marginal utility of income that's fairly essential to understanding this whole policy idea. And it's that if you take a family with $10,000, they spend all of that money for food and rent, essentially. So the first $10,000 of income has a very high value. If you take a family with $1 million of income, the last $10,000 of income, what they make over $990,000 has very little value. Maybe it's additional luxury consumption, a little bit of additional investment, but the marginal value is far lower. So that motivates the whole notion of progressivity in taxation, which is, okay, that family with $1 million of income is much less burdened, even by a much higher tax rate, because not only do they have their cost of living covered, they still have a lot of money left over for luxury consumption and investment, even if they're paying a much higher tax rate than the poor family. You tax the poor family at 10%, and that it represents a real hit to their quality of life and their ability to sustain themselves. So what this chart does is it kind of sums up the total tax burden for all these different income sectors of the state population. And what you can see is that overall, we have a regressive structure, which means that lower income people are more burdened than higher income people. This accounts even for the tax hikes on the rich that were enacted in 2021, which we'll talk about later. But even accounting for those relatively higher income tax rates on people making millions of dollars a year, you still have a middle class that's paying a larger share of its income in taxes than the ultra rich. Really, you would want the bars on the top 5% and the top 1% to be much higher. And even if they were much higher, those people would still be considerably less burdened than the middle class taxpayer that's paying 13% of their total income in taxes. So with that in mind, one of the the biggest things to do that might sound a little ordinary, but is very important, is to just continue increasing the progressivity of the personal income tax. As Andrew talked about earlier, the personal income tax is the biggest source of receipts. It's about half of tax receipts. It's a very reliable instrument for raising revenue. Sometimes we start thinking about taxing Facebook or taxing luxury yachts, and that's all nice, but really, when it comes to social policy and social investment, the focus has to be on sustainably and reliably raising revenue. And that means you start by looking at the personal income tax. Here, we evaluate a few different options, but something that's important to know about the personal income tax and what's known as the high tax state in New York is that for most people, it's pretty flat. This line accounts for approximately 100% of filers. The people who are in the sort of making millions of dollars of a year bracket, they are around 0.5% of all filers. Most people pay these rates. And what you see in this chart is that families making between $300,000 and $2 million a year, basically, I mean, they actually pay exactly the same tax rate. So what you would want to see is like much more steps in this chart, so that you're differentiating between the earning power of different groups within that range. And in addition to those steps, you kind of want to see steeper steps as well, so that we can raise more money, but also to do more in the way of progressivity and sharing that tax burden fairly. This compares the state tax rate to the California income tax rate, which is the dashed line right above the bottom line down here, and then the federal income tax rate, which of course is much higher, and that's the dotted line up top. But the thing to notice here is that the progressivity of the federal and California income taxes is much higher because their high rates kick in at a lower level. So the highest federal income tax bracket for a married couple is about $620,000. And in California, their highest rates apply to married couples making just over $1 million. So by contrast, in New York, we have these higher tax rates on the millionaires, but they rise a little bit for a married couple making $2 million. And then we have these $5 million and $25 million brackets. So that's extraordinarily rich to make $25 million a year, but it also kind of undermines the progressivity of the structure to push the higher rates way up into the income bracket. And then you look at the news coverage or what people say, and they say, oh, New York has the highest tax rate. It's almost 11%. That's true, but it's on people who make $25 million a year. So it doesn't give you a very accurate snapshot of the state tax to be thinking about it that way. So without kind of droning on about numbers, here we chart and estimate 3 different proposals to increase progressivity. One would be kick up those higher rates a bit. 2 would be to really move towards a more properly progressive structure with new brackets for people earning less than $1 million. And then the third one we estimate is currently a bill that's been sponsored by Senator Robert Jackson, which would impose much more progressive and much higher tax rates. And even though those rates would be pretty high by state-to-state comparisons, they're actually in line with what a lot of economists estimate that the income maximizing or sort of optimal tax rate on the rich should be. So, the first option, if you just raise the rates a little bit, you're talking about $1.5 billion. If you move to this option 2, where you would be raising taxes on people making under $1 million, we look at, say, married couples making about $750,000. That would raise about $6.5 billion. And this very aggressive proposal, believe it or not, we think could raise about $50 billion. Of course, that's assuming no mobility, but that's the way you do revenue estimates, is you just start from where you are and you assume that behavior is steady. There's good evidence for the proposition that people really don't move in response to income tax rates. So I think it's not an unreasonable estimate, but those are the numbers that we came up with. And it's interesting to think about where we could go in terms of state social policy if we really had access to those resources. There's another income tax option that's important to think about, which is a sort of subset of income, which is income from investments or long-term capital gains. And long-term capital gains get a significant tax benefit at the federal level. For the highest income taxpayers, it's about 17% with a few caveats. And there's long been this kind of theory that we want to incentivize investment, and so people need to get a better return on their investment income, but it's long been opposed by a lot of even kind of center-left legislators who believe the policy analysis and the economic analysis that says that it's actually not really a good strategy in terms of incentivizing investment, and also just think that it's pretty unfair to give rich people a really significant tax break on their investment income. So you could do a small surtax on that income from investing and raise a few $1 billion at the state level. I'm going to move pretty quickly through the last of these proposals so that we can take any questions. Still on capital gains, you could tax those gains as they arise rather than waiting for people to sell their assets. And this is the concept of the Biden proposal to do a billionaire minimum income tax. If you did this at the state level, we think that it would raise about $1.5 billion annually. There's also, somebody should ask about this, and we'll go into some detail. New York has a special tax that applies to businesses that are not corporations, like partnerships and LLCs. And I have a slide here that kind of shows you the difference between how those businesses work. But basically, most businesses don't pay the corporate tax. What you see on the left is a corporation. It gets taxed on its income, and then it distributes its profits to shareholders as dividends. And those are the two levels of taxation for a corporation, because shareholders are taxed on the dividends they get. Most businesses aren't organized that way. Most businesses, LLCs, partnerships, S corporations, they're like the business on the right of this slide, where all of the income of the business just gets taxed directly to the business owners. There's no entity level tax, but we have an entity level tax now called the pass-through entity tax, which is basically just designed to help business owners work around the federal limitation of the state and local tax deduction. If we were to just slightly reduce that rebate, the state could pick up about another $1 billion. We worked through some of the math of the SALT deduction here, in case anyone has questions about that. That's on the business tax side. The important thing to know about business taxes is that they've generally been declining, both because of this shift out of corporations and also just because corporate tax rates have been declining. So this shows you the decline in the state corporate tax rate over time. There's room to raise the corporate tax. This shows you that corporate tax revenues as a share of overall receipts have been declining considerably since the 80s. So again, basic sound tax policy would be to continue marginally raising the corporate rate, bringing in stable revenue, and increasing the share of overall business receipts of the state's total tax receipts. Another proposal we have, there's an aspect of the 2017 Trump tax law called the Tax Cuts and Jobs Act that taxes multinational profit shifting. So basically corporations get taxed on the sort of foreign subsidiaries that are super profitable because they've shifted valuable intellectual property into those subsidiaries. There's an opportunity for New York to pick up some of this revenue by increasing and changing the way in which it conforms to that federal law. This is called GILTI. I think they spent a lot of time on the acronym. Here we go. Another real pillar of our whole tax system is taxing estates at death. This is really the one thing that we have that's like a wealth tax. When somebody dies, the value of their whole estate is subject to the estate tax, which is effectively a tax on their wealth. Unfortunately, this has really been hollowed out over decades of legislative changes and tax planning innovations. And so there are a number of ways that we recommend where you could turn the estate tax into a far more functional tax on accumulated wealth at the end of an individual's life. And lastly, you may not know that the state constitution actually prohibits a wealth tax. The strict wealth tax this dates back to 1920 or so. In order to have a wealth tax, you would have to tax people's intangible property, basically things that aren't like buildings and equipment. And the state constitution restricts it. So a lot of people are talking about wealth taxation. It's under consideration in a lot of states. And so that we think the state would be wise to explore options for doing that and to begin by changing the state constitution. Finally, the tax code is also a spending tool, not just for businesses, but as a mechanism of poverty relief. And one of the two really important poverty relief mechanisms that we have in the state is the Empire State Child Credit. But there are a few huge flaws in it. One is that it excludes children who are under the age of 4. There's no discernible policy rationale for that. It also needs to be extended to include people who don't file with a social security number, especially undocumented immigrants. And lastly, there's a little phase-in. So if you're too poor, you don't get this anti-poverty tax credit. You could change all of those flaws for about $300 million. And in this budget, given the sort of absence of aggressive spending proposals, we think that it should at least consider making these pretty obvious changes to the Empire State Child Credit. So that's the end of our presentation. And now we'll move into some time for questions. Please just write them in the chat and we will reply as appropriate.
And a couple of folks have been asking about video of the presentation, which we will be sending out, and we'll also be sending out the briefing book shortly. Andrew has also been answering some of the questions in the chat, but we still have some open. Someone asked, could and should making our tax system much more progressive help to reduce property taxes?
The short answer is yes. The truth is that there is a lot of revenue that comes in from property taxes. I think in total it's around $40 billion. So honestly, you'd have to have pretty significant income tax increases to start offsetting those property tax receipts. But it's definitely one of the longer run trends in the state that basically income tax cuts forced local property taxes to go up in order to make up lost revenue for local governments.
Someone asked, would casino revenue be diverted from K through 12 education or from higher ed?
In K through 12.
Okay. Does some of the foundation aid end up going to charter schools?
You know, I would direct you to education experts for a more detailed answer. But so foundation aid, I believe, does not go to charter schools, but the charter school do receive a formula-based aid that's sort of packaged along with foundation aid. So I think it does end up diverting some of the general school aid that's provided by the state. That would be part of the amount I referenced in this presentation. Yeah, you know, if you watched the mayor's testimony to this on the state budget yesterday, it was interesting because the mayor sort of conditionally is in favor of charter schools, but was against the charter school expansion because it would entail diverting some funding to these charter schools, and the state isn't funding it. So some of this funding is diverted. Yeah.
Okay. For the slide with the list of economic development programs proposed to be expanded, do you have values of the expansion? For example, the film credit you mentioned would go from 200 million to 700 million.
So off the top of my head, I know that the expenditure that they estimate with the film tax credit expansion is, I think, 208 million in fiscal year 25. And that's the biggest tax expenditure of those proposals by far. And then The remaining ones for which the state does include estimates, we have those estimates in our report. So we're going to send out the report, and I would just direct you there.
Great. A couple more. With a tight labor market and low unemployment, we would expect higher wage growth, but we haven't really seen this. Any thoughts on why? Can you provide any commentary?
Well, it's a good question. So the wage growth metrics that I've shown in this presentation are adjusted for inflation. So they look pretty low. So we have seen a tight labor market. We've seen nominal wage growth, and we've seen high inflation really chip away at those gains, such that I think overall personal income is about par, and then sort of average wage growth is up a little bit, but it's not as much as you would see with a tight labor market and no inflation or normal inflation.
Someone asked about land value taxation to capture unearned wealth increases due to location.
Yeah, you see a lot of people talking about land value taxation. I mean, I think there's certainly, there may be two sides to it. One is that the property tax system definitely needs to be reformed, and I think it would be wise to take a leaf from the land value tax theorists and think about how to increase basically the mechanisms within the property tax that tax excess returns just for land ownership. On the other hand, frankly, I tend to be a little bit wary of the traditional land value tax theory, which can end up being very regressive and also probably makes some questionable claims about economic theory more broadly, and land being the only source of economic rents.
Okay, and we've been asked if we also provide a report of state impact on the city budget.
Not presently. I think one day in the future, but you're looking at the whole FPI team. So our focus is really on the state budget at this time.
Great. If anyone has any final questions, please add them in. If you think of additional questions, you can always send them to us. Our email's on our website, and a lot of the answers to these questions will be in the book. Anything else, Nathan, Andrew?
Thank you all for coming today. Thanks for sticking with us a little bit over. As I said, we'll be sending out what is a pretty hefty publication that describes everything we've said today in greater detail. And you may find especially interesting this lengthy chapter at the end that really tells the story of what happened in the 15 years between the global financial crisis and COVID in terms of state finances and state policy. So please get in touch if you have any questions, or if you have recommendations or want to talk to us. We're always happy to chat, and we look forward to seeing you at our next budget briefing in 2024.
Thank you all.